Hey, this is Anthony Taryn Bernard with the Calgary Real Estate Investor Hub. Today we'll talk about how to buy your first rental property step by step. First thing you'll have to do is to save for your down payment. Okay, so how much down payment do you need to save to buy your first rental property? Well, it depends if you're going to be living in the property or not. If you're going to live in the property, let's say you're doing house hacking where you live in one unit and rent out the other, your minimum down payment would be 5%. And that's what we call the high ratio mortgage. Those are insured mortgage, usually with CMHC, but there are other insurers as well. And the way it works is you'd have to pay an insurance premium, which is on a 5% down payment. It's 4% of the loan amount, of the mortgage amount. So on a $500,000 property, that would be a $20,000 insurance fee and $25,000 down payment. So your mortgage amount would be $495,000. And again, that insurance amount would be amortized throughout the life of the mortgage. Maximum amortization of those mortgages is usually 25 years, unless, and that's a new rule, but unless you're buying a new construction, then you can stretch that out all the way to 30 years. Next option is if you're not going to live in the property, then you need to give at least 20% down payment. Those are non-insured mortgages or conventional mortgages. The interest rate is typically a little bit higher, because you don't have that insurance. And the amortization can be up to 30 years, regardless if it's a new construction or not. Next up, you'll need to make sure you have a good credit score. So typically, you want to have over 700 of credit score to be able to get a decent mortgage for a rental property. Obviously, if you have a higher score, you can get access to more loan options and typically get a lower interest rate. It doesn't mean that if you have a credit score under 700, you won't be able to buy a rental property, but you might have to pay a higher rate, go with B lender options, things like that. So how can you improve your credit score? If you look online on YouTube, you'll have all sorts of different ways you can improve your credit score, but the main basics are to make sure that you pay all your credit cards on time. Even if you don't pay the full balance, make sure you pay at least the minimum balance on time every month. Make sure your credit utilization is not too high. If you have a small credit card, even if it's a small balance, let's say $1,000, but you're using 100% of that balance every month, that can hurt your score. Things like that do take some time, so you want to make sure you start to work on that as you save your down payment to get the best credit score you can. As you build your credit score, something that's really useful is to use credit monitoring service like Equifax, Credit Karma, and a lot of other ones out there, so that you can actually see the inquiries that you have on your account, what accounts you have open, and how your score is progressing over time.
Next up would be your tax returns. So you want to make sure you differentiate between you being an employee and you being self-employed. So if you're a full-time employee, banks or lenders are typically going to be using your T4 job income to qualify you for a mortgage or for lending purposes. Whereas if you're self-employed, say you're an independent contractor or you have your own business of sorts, then the banks are going to look at your 2-year average of your net income that you've declared on your taxes, and that's what they're going to use to qualify you for a mortgage. So you want to start planning ahead of time, especially if you're self-employed. Make sure you're not deducting too much expenses, and make sure you show a decent income for your last 2 years if you're planning to get a mortgage in the future. The next step to buying your first rental property would be to start having a conversation with mortgage brokers or the lender that you're going to be going with. You want to start a conversation with them and show them your credit, show them your pay stubs, and have them run some preliminary numbers of what you'll be able to afford. That way, when you start shopping and browsing for properties on the market, you have a narrower range and you know exactly what type of properties you're going to be qualified for, and you're not distracted in looking at properties that are out of your price range. Now that you've established your relationship with your mortgage broker, figured out how much you could qualify for, now would be the discovery phase. This is the phase where before you start throwing out offers, you've started working with a realtor and they've set you up on a search to feed you some properties every day. And using this search, you're basically educating yourself on the market. It's a discovery phase where you're looking at all the various types of properties within your criteria, the different price points, the locations, the tenant profile, what type of rents you can get, how much renovations cost, so on and so forth. Once you start to get more informed about this and you're educated about these topics, now it's time to start making some serious offers. And when you start making these offers, you're also going to feel more confident because you know what the property's worth and what type of work you'd have to put in as well.
Okay, so what property type should you focus on? Well, that depends what your investing goals are and obviously what your budget is as well. If, for example, you're looking for cash flow, then usually you want to look at something that's got more than one unit, especially for the Calgary market. Usually cash flowing properties are 2 or more units. Maybe you're looking for something that has lower management requirements, right? If that's your goal and you're willing to forego some cash flow, then maybe you'll be looking more at something like a townhouse or a condo, right? So it's really depending on what your investment goals are, but you need to be very clear on that. So now you'll have to also decide what kind of neighborhood you want to invest in. So usually we grade neighborhoods from like A to D, and those are subjective grading, but essentially an A neighborhood or A plus neighborhood would be a more luxury area, higher price points, newer neighborhoods or neighborhoods that have more amenities. And a D neighborhood would be somewhere that's typically lower income, older properties, not quite maintained as well, and not necessarily as much amenities. Now, it doesn't mean that A is better and D is worse. It depends on your investment style and your investment goals, and these areas have trade-offs, right? Typically, for a first-time investor, we recommend most people start with the B or C area. Why is that? Well, the B areas usually are cheap enough at the price to rent ratio that you can still get cash flow and you can still attract a good enough tenant profile to not have too difficult of a management going forward. C neighborhoods are good options as well. They typically cash flow a little bit better, but you might have to deal with a bit older properties, potentially a bit of a different tenant profile, but they're still good places to start. We typically recommend investors stay away from A and D areas for their first investments. A areas being too expensive, usually you're going to be cash flow negative, and especially earlier on in your investment portfolio, that cash flow matters more, right? It's a defensive measure. And D areas just being typically too difficult for tenant management, especially as a first-time investor. Okay, once you've figured out what kind of neighborhood you want to invest in, you'll also have to look at the location within that neighborhood. So there's a few factors that are important to look at and will have an impact on your investment. Some of those examples are if it's close to a busy street. Typically, if the property has a really busy boulevard or a highway nearby, it's not as attractive, especially from a resale perspective. Now, that being said, it doesn't mean that you have to shy away from all busy road. If it's, for example, a connector road, or maybe it's a boulevard that doesn't have really high traffic, it can actually be attractive for tenants. A lot of these streets have more transit options. Bus stop might be nearby, but you have to keep in mind that at the resale, if you're looking to get someone else than an investor to buy it, it might be a bit more difficult. And as a general rule, you do still want to shy away from a street that's really difficult. For example, if there's no parking at all, or if it's really loud. Typically for first property, stay away from those. You also want to look at what's around your property, right? And that will matter more depending on the type of property you're buying. For example, if you're buying a more luxury home and it's got a huge multifamily building beside it, that's obviously not going to be helpful for the appreciation of that property, and it's going to be harder to sell down the road. But conversely, if you're buying a fourplex and it's got another fourplex beside it, that might not be as much of an issue, right? So you do want to look at what's around the property. Okay, so one thing you really can't change is the location. So you're going to want to spend some time looking at what's around your property, what transit options are available, what amenities are in the neighborhood. Typically, transit is not a requirement per se for tenants, but it does depend on your tenant profile. If you're in an area, for example, where your tenants don't have cars, then you want to make sure that there's an LRT nearby or rapid transit or some bus options. Okay, so another point regarding location that you want to be careful with is amenities. So one thing that's really important for tenants is to have amenities around where they live. An example of something you want to be careful with is new constructions. A lot of the new neighborhoods might be really good neighborhoods in 5 or 10 years, but may not have grocery stores, gas stations, restaurants, like the kind of things that people need on a daily basis. And for a homeowner, that might not be a huge deal because they might move in that neighborhood and tell themselves, like, it's okay, for a few years, we're going to drive a bit further. And then eventually we'll have everything we need around, right? But for a tenant, they want that now because otherwise they'll just rent somewhere else. For tenants, they don't really have that long-term horizon for that neighborhood. So you want to make sure that wherever you're investing has these amenities now. Okay, so that talk about location ties into something else that is really important when you're buying your first rental property. It's more important to get the right property than get, quote unquote, a good deal. And the reason for that is if you're going to buy something that you're going to keep for 15, 20 years as a buy and hold, you can't change the location. You can't change the layout of the property. You can't change the tenant profile unless there's gentrification, the neighborhood changes down the road, right? And getting like a good deal, say you get $20,000 under market value, is not going to matter in the long term as much as getting a property that's going to perform well for that entire time period.
All right, next up, let's talk about renovations. We find that with rental properties or investment properties, they often need some type of renovation or updating, especially in the case of older properties. But how much renovations do you want to take on? First-time investors, or if you're just getting started into the real estate investing of the rental property game, to take on renovations that are fairly minor or small renovations at best. This is mostly, when we talk about this, it's mostly cosmetic renovations, such as painting, maybe changing out some carpet into vinyl plank or some type of wood flooring to make it more durable. And one thing you want to keep in mind with rental properties is you don't need to go for the most expensive high-end finish. You want to go for something that's mid-grade and durable, yet attractive to bring tenants into your property. When it comes to your first renovation, you always want to budget extra costs. Typically, you want to budget at least 20% more than what you think it's going to cost you, at least 20% longer in terms of the time it takes. So if you're thinking this is going to be a 5-month renovation, count on it being a 6-month renovation, because sometimes renovations do take longer than what you expect. And as I was alluding to earlier, make sure you go for durable finishes that still look good, because in the case of rental properties, tenants are never going to treat your property as nice as their own property. So stuff will break, and you want stuff to last as long as possible before you have to replace them. Another thing to note is when you buy materials for your rental properties, for example, you're buying a doorknob, make sure you buy multiple of those and make sure that it's a design that's readily available at the hardware store, so that if and when it breaks, because it will break at some point, then it's easy to replace and find a similar style to put in, as opposed to some obscure style if that's what you put in originally. Next, let's talk about cash flow. So cash flow is often challenging to obtain in Calgary when you don't have a property with at least 2 units. The moment you start to go into a property that has at least 2 units and up, so this is typically either a suited semi-detached property or a detached property with a basement suite, or anything larger than that, such as a full duplex with basement suites, essentially a fourplex, and beyond, that's when we start to realize cash flow. So it's important to keep this in mind when you're shopping, specifically in the Calgary area. Now, this might vary depending on where you're looking at. For example, if you're in a lower priced market, you still may be able to cash flow with just a single family home without a basement suite. So yeah, this is something you'd want to research in your local market as well. Next up, you're doing property viewings. During these property viewings, it's important to focus on a lot of the big ticket items, because a lot of the small stuff like paint and dings and drywall can be fixed relatively easily. But the big ticket items will cost you money. So things that you want to look for are the roof. And if you're not a home inspector, you don't have a ladder, that's okay. You can generally get a pretty good idea by looking at a roof from the street, as long as you can walk further back and get a decent view of the roof. It'll give you a rough idea as to how the condition of the roof is. And you can further evaluate this during your home inspection. Okay? And you also want to check out other items such as the age of the windows, when were they replaced, the age of the furnace, because furnaces can cost quite a bit of money if they break down at, especially at an unexpected time. And how old is your hot water tank? These are the key components that cost a lot of money in your home. And as an investor or as a first-time landlord, you want to make sure that you're kind of mitigating the risk when it comes to these items so that you don't have any unexpected surprises. Another thing that you want to consider is the property located near a busy roadway or a train track? If so, make sure to plan your viewings according to when you'll experience the most amount of traffic or noise to see if that's something that you're comfortable with. For example, if you're located right next to a busy road, try to book your showings around either the morning or evening rush hour to see how the noise is around the property at peak traffic hours and see if that's something you're comfortable with. That way you know exactly what you're getting into. Similar example would be if you're located next to a train track, you want to figure out how often does this train run and how long do the trains run for. If you're buying a property located near a noisy roadway or a train track, make sure to open the windows to feel how the ambient noise is in the property and see if that's something that's tolerable or not. Another thing you want to look for when you go to property viewings is to see if there's any smells, right? Does it smell musty? Does it smell like something's rotting? Does it smell like cigarette smoke or even a faint hint of it? Does it smell like cat urine or animal feces? These are things that we've seen as realtors, and you should also be mindful of this. And if you experience any odd smells, make sure to do your due diligence on that, figure out what the source is. Next up, you want to be checking for water leaks. You're not a professional home inspector, but you can still do your own due diligence before you get an inspection. We often like to look for things like opening the cupboards under the sink, opening the cupboards under the vanity, see how old the pipes are. Do you have poly B plumbing in place? Are there any active leaks, or do you see any signs of former leaks? And this way you can investigate if something fishy is going on. Next step will be to check the water system of the house. So whenever you go to a property viewing, make sure you open all the taps, check under all the sinks, flush the toilets, make sure nothing's leaking or nothing funny is happening. And if you do find something, then that's an opportunity for you to do further due diligence down the road. One more thing that you want to consider is usually when you go to property viewings, the tenants or the homeowners are usually not there. But in some cases, the tenants choose to stay in the property while viewings happen. And that's great for you as the investor buyer, because this gives you an opportunity to talk to the tenants, ask them how long they've been there, if there's been any quirky issues that the buyer needs to be aware of, or if there's any deferred maintenance that needs to be done after you take ownership of that property. So that basically wraps it up. These are some of the kind of the big ticket items, kind of the red flags that you want to watch for when you go and do your property viewings.
Okay, so now that you're ready to look more actively for property, you're going to want to make sure you have the right realtor to work with. So a few things you want to look for is make sure that the realtor has experience with investment properties. Especially as a first-time investor, this is really important. So you want to look for what kind of experience that realtor has. So do they own any rental properties themselves? Have they helped other people buy rental properties? Do they understand how to calculate cash flow? Do they understand how to calculate return on investment? Do they know the rents in the area that you're going to buy in? Do they know which areas are good for rental properties? Things like that, right? You want to make sure you're working with someone that really understands that, and ideally someone that's focused on investments as their specialty. The other thing you want to look for is their availability. Especially as an investor, often you need to get in the property fairly quickly if it's a hot property or good deal. And unfortunately in our industry, some realtors are really slow and can take a few days to get back to you. You want to make sure you work with someone that's going to be responsive to answer your questions and be able to get in the properties quickly. Okay, so now that you found a property to write an offer on, let's go over some of the main points you'll have to look at to write up the purchase contract. Okay, so as part of your purchase contract, you're going to need a deposit. On a $500,000 property, that deposit is typically $10,000 to $20,000. That deposit is refundable if you don't go through with the purchase within your condition period. So if, for example, you can't get financing and you had a financing condition and you have not waived conditions, you get back the entirety of that deposit. If you do waive conditions and now the deal is firm, and for whatever reason you either change your mind or can't purchase that property anymore, you do lose that deposit. You could get sued for amounts higher than the deposit as well if the seller can prove that they had damages, but by default, you lose that deposit amount. So you do have to be careful to offer an amount that you're comfortable with. But again, typically on a $500,000 property, you look at $10,000 to $20,000 at different price point that changes. Okay, so next up, you'll have your conditions. Common ones are financing and inspection. It's not required, right? There's investors that will purchase a property unconditional, that we call, so they won't have any financing or inspection condition. But as a first-time investor, we generally recommend that you add those in. So financing condition will allow to make sure that your mortgage broker or your bank reviews your file and gives you what's called a commitment letter. And from that point, you can usually feel comfortable enough that you will get the financing at closing. And then you can waive conditions. What it allows is if there's any issue within that time period with the financing, you can back out of the deal, get your deposit back, and you're not tied to purchasing that property. Inspection conditions, very common as well. As Santosh covered earlier, as part of your viewing, you're going to look at the main items in the property, but you only have so much time when you're doing a viewing. And also, the inspection condition allows you to bring a professional in, a home inspector, that's going to look at much more items of the property that you can't quite see in just a viewing. For example, they'll be able to climb in the attic and look at the insulation up there. They'll be able to climb on the roof or run with the drone and see the condition. So it is something that we generally recommend as well, but it is not required. There's other conditions you can add as well in your purchase contract. For example, you might want to have some walkthroughs, which would allow you, once the deal is firm, to go in with the contractor, for example, and get some quotes if you're looking at doing renovations. Typically, we are going to want to do what's called a pre-possession walkthrough, where a day before you close on the property and take possession, we usually go in and make sure that everything that was in the purchase contract, like appliances and things like that, are still there, that there's no additional damage on the property, because essentially the time that the seller accepts the purchase contract, they have to provide you the property in the same condition than it was at that time of contract. Some of the other conditions you might have in there might include taking over a tenant. If the property is tenant occupied and their lease is still active by the time you buy the property, you want to make sure that you have a condition that stipulates you'll take over the tenant, and you also want to add a tenancy schedule that has the details on what the lease are, whether the lease amount, the terms, tenant names, things like that, to make sure, again, that that doesn't change between the time you buy the property and the time you actually take possession. Next up, you obviously have the possession date, right? So that's the date you'll actually get the keys for the property, and that's also the date you'll have to provide the funds to buy that property. So let's say that you have a possession date that's in 3 months. You don't actually need to provide the funds until you get the keys. The only thing you need to provide up front is the deposit amount that we discussed earlier. Okay, so now that you got your offer accepted, hopefully, now it's time to rent out the property. So a few tips here on the rental. If you're going to do it yourself and self-manage the property, which we do recommend for a lot of first-time investors, is you want to make sure that you take some good photos. That might seem like a given, but unfortunately, we see very often absolutely terrible photos on the internet, on rental listings. So make sure you go in the daytime when there's good light coming in the property. Open the blinds, try to show the natural light that comes in. If you're not great at taking pictures, maybe it is wise to hire someone to do it. But you know, the phones these days, as long as you take your time, you can usually get some good pictures. Next up, where to list your property. Well, this depends on the market you're in, but for Alberta and for Calgary, rentfaster.ca is a very common, very popular website for listings. There's a lot of great tenants that comes from there. Facebook Marketplace is also very big for rental property listings. You can also look for Kijiji, and you can look also at other websites like rentals.ca. We recommend that you try to list it on as many platforms as you can. The idea is to get as much exposure as possible, right? There's really no downside in getting that extra exposure. It just gives you more lead to go through and finding the right tenants. Okay, so now that some tenants are starting to reach out to you, Next thing you're going to want to do is a pre-screening. So we use a questionnaire usually where you can go through and check for the main things, right? Like, for example, how many people are going to live in the property? Do you have any pets? If you do, what kind of pets do you have? Is it a dog? What kind of breed? Things like that. It's like the big stuff, right? You're just trying to figure out if they're going to be a good fit or if there's no way they're going to be a good fit for your property. Once you've filtered out the ones that seem to be good prospects, we do recommend that you use a system to book the showings. If you go back and forth with tenants and try to arrange times, it can be very cumbersome. So we personally use Calendly, but there's a lot of other good softwares you can use for that. And then tenants can book directly in your calendar. So you can block out times for showings, and then you don't have to deal with that back and forth trying to book showing times. Another thing we find that's really important is to respond quickly to tenant inquiries. If you leave it there, for a few days, usually they'll move on and find another property. So now that you've done some showings and you have some tenants you might be interested into that seem to be good candidates, make sure you screen them properly. We do use some services that will allow to look at background checks. So it looks for police checks, does quick internet search as well. It will look for credit score. You want to make sure that they have at least a decent credit score, that they don't have anything that could impede their ability to pay for the rent. You want to make sure you look if they're on any sex offender list, especially if you have a shared property. Okay, so now that you purchased your first rental property, what do you do next? Well, I think for most investors, you start the whole process again. So you start to save up for your down payment again for the next property. But there's something else that happens is now that you have this property, over time, paying down that mortgage and value increase, you can now potentially in a few years refinance some equity out of that property and help you to buy the next one. So those are the steps to buy your first rental property. If you like this video, please click the like button below and subscribe for more videos like this.